What's up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. So ever since we returned to YouTube and over at Stocktrades.ca, just emails and inquiries from our readers, there has been an explosion in popularity for dividend-related content. Back in 2020, back in 2021, it was all about growth, and now that growth stocks have pretty much capitulated for the most part. There are some strong ones still surviving, but a lot of small caps and speculative companies have taken an absolute beating in 2022. Many are resorting to dividend-paying blue-chip stocks. So we're going to continue on with that type of content, and in this video I'm going to be speaking on some very popular Canadian dividend ETFs, and I'm going to get into some pretty glaring warnings about these ETFs, whether or not I like them, whose portfolio they would be particularly useful for, and I'm just going to get in depth on three of the best ones in the country I feel all around ETFs for investors, Canadian investors who are looking for that increase in passive income. So with that said, let's jump right to the screen and get right into the video. So before we get started with the video, remember, like the video, comment down below. Let me know if you like this type of content. Let me know if you want more of it, less of it. If you want me to focus on US stocks, growth stocks, whatever it may be, make sure you're letting us know. That's exactly how we develop content like this. So in this video, I'm going to go over three of the most popular Canadian dividend ETFs and three that I really like. On our website, on our Best Canadian Dividend ETF post, we have 10. We cover 10 Canadian dividend ETFs. I'm not going to go over all of them inside of this video just because it would run on for longer than an hour, but we do cover all of these ETFs, and it is in-depth analysis. You will not get better analysis than you see, particularly for free, than you will get on Stocktrades.ca. This is why we have grown into one of the largest investment-based websites in Canada with over 1 million visitors every single year. So head to the website. I'll drop a link up above if you want to see the full description of these Canadian dividend ETFs. But in this video, I'm going to go over three in particular I feel will provide a little something for everyone. One of them is going to be a very niche ETF. The other one is going to be a pretty standard broad-based ETF. And the other one is going to be a high yielder. So for those who want that little bit of boost, higher income, make sure you watch until the end of the video. But the first one we're going to go over is the iShares Canadian Monthly Income ETF. So this is not exactly a broad-based Canadian ETF. In fact, it is mostly focused on the financial sector. If we look to the total allocations of this ETF, we can see that it has a 92% weighting to the financial sector and around 7.8% to the real estate sector. So this is not going to be your typical Canadian dividend index fund. This is a fund that aims to target high-yielding financial-based companies, and along with that, it also targets a fixed income element to boost your income. So this is not something you will see in very many Canadian dividend ETFs at all. So it has 71% exposure to intermediate bonds and 28% exposure to long-term bonds. They do this to increase the income, and as a result, the majority of this fund, the fixed income portion of this fund, is actually in BBB rated bonds. So 55% approximately in BBB rated bonds. And what this means is you're going to get higher yields out of these companies. Now, there are a lot of strong companies that are BBB rated. Are they higher risk than a AAA graded bond or a AA? Yes, they are, but you will see very strong companies have BBB credit ratings. So you're getting higher yields, but you're also still getting very strong companies. And as we can see, 70% of this ETF is focused on large cap value stocks. That is pretty much the bulk of this portfolio. I mean, we have around 9% blended large caps, but there's only around 8.5% of the portfolio that is allocated to small cap value. And it is very likely that this exposure is to Canada's alternative lenders and maybe some smaller insurers. The overall objective of this fund is to generate a minimum monthly cash distribution. So 5 cents per unit, $60, 60 cents per annum. So there is no assurance that FIU will achieve this investment objective, including making those distributions. But overall, the overall distribution should continue to be paid. It yields around 7.1%, which is quite a bit. It's actually going to be the highest yielding Canadian dividend ETF on this list by a landslide. A lot of people buy this because it pays that strong monthly income, especially those who are in retirement, who are willing to diversify their portfolio away from 100% equity. As mentioned, this fund contains around 30% fixed income, so it's going to have a little bit lower volatility, and it's also going to provide you with that stronger income. So we can see that the top two holdings in this ETF are the preferred share ETF and the corporate bond ETF. So as of right now, around 30% of this fund is fixed income. And when we head down to the other holdings, we can see that this is a very large play on Canada's big six banks: Royal, BMO, Canadian Imperial Bank of Commerce, TD, and then we have Manulife Financial in there, and then we get right back to National Bank and Bank of Nova Scotia. We can see a ton of high-yielding Canadian financial companies in here: Power Corporation, Manulife, Canadian Imperial Bank of Commerce, Bank of Nova Scotia. These are all the higher yielding financial companies, and we can even see Artis REIT, H&R REIT. These are the higher yielding Canadian REITs that they add into this portfolio. Again, that small cap value comes from companies, as I mentioned, those smaller cap financial companies: Equitable Bank, Canaccord Genuity, and Canadian Western Bank. So in terms of performance, this ETF has kind of gotten thumped this year, and that is primarily due to its focus on fixed income. Its one-year returns sit at 11%. Year-to-date, loss around 12.4%. This is much worse than the TSX, primarily because the TSX has been relatively strong because of its oil and gas exposure, but it is also due to the fact that this is a pure play financial ETF. With the upcoming potential recession, financials have been under pressure, and with the rising interest rates, fixed income and preferred shares have also been under a significant amount of pressure. If we start to see interest rates flatline, if we start to see them even potentially come down, or we see a recession avoided, this ETF could potentially outperform, because that fixed income and bond element is going to start to see price appreciation, and also these financial companies could see a big rebound if the economy stays relatively stable and we don't see earnings dip in a big way. Overall, if you're looking at this ETF, it would be purely for exposure to the financial sector, and you want that boosted income in the form of fixed income and bonds. But the next ETF we're going to go over is a BMO ETF, and it is a relatively well-rounded ETF, and that is ZDV.TO. So overall, if you have read our content over at Stocktrades, if you've watched a ton of videos, you will know that I am a huge fan of BMO ETFs. I think they provide the best range of ETFs. They have a little something for everybody, and ZDV is certainly one of those. So this is not an index fund. This is a dividend ETF that seeks to provide exposure to the performance of a yield-weighted portfolio of Canadian dividend-paying stocks. So these selected companies by the fund will have the potential for long-term capital appreciation, but will also be weighted based on yield. So you're going to get increased income from this. So expense ratio of 0.35, meaning you'll pay about $3.50 per thousand invested. And I did forget to go over FIE's expense ratio. It is a bit high because it's such a niche ETF at 0.81, so you'll pay around $8.10 per thousand invested on an annual basis. So assets under management of $974 million. So when we go to overall performance, and this would include the dividends paid, we can see, year to date it's up around 1.15%, but when we look to 10-year annualized returns, it sits at around 7%, and this is pretty decent for a fund that contains a lot of companies with mature business models that are providing higher yields right now. And because this is a yield-weighted portfolio, it actually might pick out a little bit of struggling companies that are providing higher yields, hoping for a potential rebound. And as a result, if this hasn't happened yet, performance could drag based on this. But when we look to shorter term returns of 8.28% over the last 3 years, this fund actually has outperformed the TSX. Now, in terms of overall holdings, it does have a fairly concentrated portfolio, which, to be honest, in terms of the Toronto Stock Exchange, this is a good thing. I know a lot of people believe in, the lower holdings in an ETF, more concentration risk. I believe in Canada, you kind of want that concentration risk. We have a lot of material-based companies, oil and gas-based companies, financial-based companies here. So to individually select a more narrow approach in terms of Canadian holdings, I think is actually a benefit to somebody holding this fund. And when we look to overall holdings, this might seem a little bit confusing because Royal Bank of Canada is not even close to the highest yielding Canadian bank, and it has the highest weighting in this portfolio. So it's not directly related to yield. This is still a fund that is managed and handpicked selected holdings. So they're not just going to take the highest yielding stocks and make them the highest allocations. But when we look down, we can see that higher yielding options like BCE are picked over TELUS, even though TELUS has been the better performer, and Bank of Nova Scotia and Canadian Imperial Bank of Commerce are higher holdings than, say, National Bank, Bank of Montreal, even though their performances have greatly lagged those other banks. So again, this does have a yield-based focus, just not purely yield-based. So let's go over that concentration risk as I highlighted at the start in terms of warnings with these funds. If we go to allocations, this BMO fund is the best balanced out of the three. So we can see that in terms of financials, it is at 38.8%. And when we look to energy, it's at around 17.2%. Now, when I go over the Vanguard fund next, you're going to see why the Vanguard fund has outperformed this fund, and it is primarily due to this energy exposure. There's a lot more energy exposure in VDY than there is ZDV, but the one reason I really do like this ETF, it is more balanced. It's one of the better balanced Canadian dividend ETFs that you can buy today. But again, it still does have, close to 60% exposure to the financial services and the energy sectors. So that is something that is important to keep in mind. So overall, this one yields around 4.22%. It's not even close to FIE, but again, it's important to remember that FIE is a financial pure play with that bond and preferred share exposure. This is a 100% equity ETF. So there's going to be a big difference in yield, and FIE aims to pay out a set distribution. So there is going to be a big difference in yield to that regard, but still 4.2% is a very solid yield for a concentrated portfolio of very solid Canadian stocks. So the third and final ETF I'm going to go over is a Vanguard fund, and this one is actually one of my favorite Canadian dividend ETFs, especially on the higher yielding side for those looking to maybe sacrifice a bit of total returns for that larger passive income stream. So overall, it is really hard to not like Vanguard funds. This fund is very similar to ZDV, BMO's fund, in the fact that it aims to track high-yielding Canadian stocks. As you can see, it yields around the same 4.26%, but there is a few key differences. For one, this is an index fund, so it aims to track the FTSE Canada High Dividend Yield Index. So this index invests primarily in common stocks of Canadian companies that pay dividends. Now, there's a few reasons why it is beneficial for this to be an index fund. For one, it makes fees lower. Typically, when a fund can track an index, there's less active management, and so the expense ratio is only 0.22%. And we can see this clearly by looking at the turnover ratio, which is only 10% for Vanguard, but when we look at ZDV, it's 22.35%. So as a more actively managed fund, ZDV has a lot more turnover, which is the purchase and sale of the stocks and holdings within that fund, whereas ZDV is much less. When we look to total size with AUM of 1.8 billion, this is one of the largest funds in Canada, dividend funds at least, and it has 1 year inflows of 521 million. So This fund has been by far the most popular on this list for total fund flows into the fund. We can see that it's not quite 30%, but you can see that around 25% of its AUM has came in this year. And when we look to total performance, this has actually been the best performing fund out of the three listed as well, and it has very strong 10-year returns. We can look down here, nearly 10% annualized, 9.43% annualized, and over the last 3 years, if we remember the BMO fund was returning around 9%, Vanguard's fund is at 11.37%. And year to date, it is in the green as well, so it is outperforming the TSX. So why has this fund performed so well as of late? And it is primarily because of the large shift to value-based holdings. When we look to the overall portfolio of this fund, ever since the market euphoria in 2021, we've seen a significant surge out of growth, speculative growth, and into value and income plays. And a lot of the companies inside of this portfolio, we can see Royal Bank, TD Bank, Enbridge, Canadian Natural Resources, especially with the rising price of oil, Suncor, again, BCE, Manulife, even though that one has struggled a bit, it seems to be stuck in permanent value mode. TELUS, National Bank, Fortis, Restaurant Brands International has saw a massive increase in price in 2022. I think it's up at the time of filming this 50%. Shaw Communications, the acquisition by Rogers. Overall, there's been some very strong movement in price with the stocks inside of this ETF, and it has allowed it to perform pretty well. Now, when we look to total allocation, we can see again that this isn't necessarily a financial pure play, but with 54% exposure to the financial services sector, you are going to be heavily exposed to Canadian finance. And the second largest exposure is energy at 28%. This is again why I've stated that these funds aren't really designed to be large core index fund holdings. There are some index investors who hold 20 to 30% of their total portfolio in an S&P 500 index fund. But with these Canadian funds, it is very difficult to do that because you are heavily exposing yourself to just a few industries. I mean, we can see that 55% and 28%, we're looking at, over 80% exposure to financial services and energy. So that is something to consider with these Canadian dividend ETFs. Overall, all three of these provide excellent exposure, excellent ways to gain income. We can see that Vanguard, it yields around 4.26%, much the same as the BMO fund. And the main difference here, obviously, as I said, is the fees, 0.22%. You'll only pay $2.20 per $1,000 to be invested in this fund. These three Canadian dividend ETFs, I think they are very strong options for those who want to build a passive income portfolio that is directed towards Canadian companies. But again, what I can't stress enough is that I wouldn't be over allocating to these dividend ETFs. No matter how lucrative the dividend yields are, they are very hyper focused in a select few sectors that could be overexposing your portfolio to not only Canada in terms of home investing bias risk, but also just overexposure to the financial sector, the oil and gas sector, the material sector. These are very cyclical sectors, not finance in particular, but considering the current circumstances and the recession we could be heading in, financial sectors could continue to see weakness. And overall, if you're buying lump sums, large allocations towards these Canadian dividend ETFs, I think you're really missing out on broad exposure to some strong dividend growth companies in the United States and some strong dividend growth companies outside of the financial and oil and gas sectors, which is what these ETFs are heavily composed of just because of the structure of the Toronto Stock Exchange. But make sure to drop your favorite Canadian dividend ETF in the comments below, and we'll see you next time.